let's get started. And thanks to everybody for joining here tonight. My name is Rick Barga, and this is Michael Elliott with Midtown Cleveland and Cleveland Neighborhood Progress. Thanks for joining us here for our last and final installment of Real Estate 101, the fourth session, talking about finance, leveraging, and return on investment. Next slide, please. So over the course of the last four sessions, we've covered a number of different topics, and we're excited to continue the discussion. I think this slide, we really want to get some feedback from you guys at the end of this webinar about what did you guys want to know more about and learn more about. So please keep that in the back of your mind. And just to give a quick recap of some of the other sessions, because I feel like as they all weave together and work together to sort of paint a picture, the first session we covered really what is real estate as we view it from two different lenses, a community development tool and a financial asset, and talked a lot about who are the different types of professionals and what are their roles in the development process.
Now, in our second session, just a quick recap, we just really talked about the development process as a whole. Generally speaking, there's three parts of the process. There's the pre-development, there's the construction phase, and then there's that lease-up aspect. During that time, we discussed the importance of that pre-development process, and that really is to resolve uncertainty. When you get into these kind of projects, you want to make sure that you're dotting every I, crossing every T to make sure that when you get into the construction or lease-up phase, you want to make sure that you're mitigating as many problems as you possibly can. So this was a very important part of the session that we hopefully everyone was able to take something away from. Next slide.
And then in the third session, last month, we really dove into a little bit about the contractual obligations of real estate and the legal backgrounds behind how these transactions happen between buyers and sellers, how they are recorded, and what is the elements of a contract and what is written down on a piece of paper. And then followed that up with, next slide, please.
And we followed it up with basically some information about law and the zoning laws that are around the city of Cleveland. Again, these zoning laws help shape what developers and real estate investors can do, and it's a very important part of the process. Next slide.
And so tonight, in our final installment, we're really going to talk about real estate finance and try to get down to some bare bones concepts and ideas, especially around the sources of funds, using the idea of leverage or debt to help finance projects, and then walk through a little bit about what does a pro forma and return on investment look like. Next slide.
All right, so as the pictures show, real estate developers can get in many different type of projects, from single family homes to large scale multi-tenant projects. But there is definitely some commonality between the different type of projects a real estate developer can get into. And one of those things that we're going to talk about is just leverage, is the sources and uses. Next slide. So when it comes to any kind of development project, you want to definitely understand that sources and must match the uses of any particular project that you get involved in. So under sources is really comprised of two things: the equity, we'll talk about that a little bit later, as well as the debt that you want to bring to the table as well too. And those typically correspond to land costs, hard costs, soft costs, furniture and fixture equipment, that's what the F&E stands for, and financing costs as well too. So let's go to the next slide and talk a little bit more about equity.
So equity is an interesting term. It can mean different things. And when we are talking specifically about equity in real estate, it means something different than just the term equity that's come up a lot in recent culture. So you may have heard the term racial equity, and that's really about applying justice and a little bit of common sense to systems that are out of balance, especially when it comes to the minority communities and the bureaucratic ways that we live. But equity in real estate means a completely different thing. And equity really focuses on the idea of the cash that you have or the value that you have that you own in your home, in your building, in your fixed asset. So today, not to confuse anyone, but we are going to be talking about money and cash. This idea of cash and equity can come in two different forms, right? There's money and there's cash that's like you're injecting right into your pocket. You're taking that from your bank account and you're putting it into your building. But then also there's a term called sweat equity, which can mean if you yourself are going to put your time and energy, your elbow grease, you're the one that's going to be carrying the bricks up to go build your home, that can also be considered equity in your project. So in two different ways, either blood, sweat, and tears or actual cash, equity is thought of as injection of value into your asset. Okay, and so the opposite of equity, of course, if we were to think back to our sources and uses, would be about debt. And so debt is a very, very powerful instrument. But just so that everyone is aware of the same type of terminology, we're talking about debt is an amount of money that is borrowed from one party to another. And so the person who is borrowing the money is called the borrower, and the person who is lending the money is called the lender. And this is really, if you have a project that costs $100 to do and you have $10 of cash in your pocket, you may need to go borrow that other $90. And so that $90 would come in the form of debt that you are expected to repay to your lender. Next slide.
We're going to take it back a little bit to high school physics, where we talked about leverage in physics class. Leverage is a physics term that refers to the ability to use something to move an object that would otherwise be too heavy. And so if we go to the next slide, in essence, for most developers, for just anyone, think about just a home that we're looking to purchase, most folks cannot take on that amount of debt at that amount of time. And so what we do is typically go into these mortgage situations, leveraging our money, which is typically referred to as a down payment, so that we can quote unquote lift something a lot harder, or in this case, purchase a home for a potential return. So one of the definitions we're using is in real estate, leverage uses borrowed capital or debt to increase the potential return on an investment, whether it could be a commercial property, residential property, you name it.
And so why do developers use leverage, right? So developers use leverage so that they don't have to use all of their own money and can keep money in their pocket while their development project occurs. And this is a way that they don't have to risk all of the money that they have in putting cash into a project. And so by using other people's money to build your building, you are in turn leveraging your own money to get the project done. Next slide.
When Barg and I were working with the city of Cleveland, one of the things that we heard from developers constantly is using other people's money. And I remember a conversation that I had with a developer, and he was just telling me that basically, hey, we're looking for any opportunity where we can get any kind of tax breaks, we can get low interest loans, because we want to try to save as much of our money to go and put it into some other type of project. Now, a lot of folks look at debt as a bad thing, as something that you want to run away from. But to a developer or to an investor, many of them look at it as a business opportunity. And we're hoping that through this course, today's lesson, that you're a little bit more encouraged to take on debt, knowing that it's going to be used to leverage for greater business opportunities down the road. Next slide.
And I might also just pause here and say, we do have some built-in places for questions. But if people have questions, feel free to raise your hand or pop it in the chat, and we will try to answer them as we go on. Thanks.
So just some elements of debt we're going to get into a little bit. So first of all, when any form of debt that you pretty much will get into, you'll be obligated to pay it back. With a predetermined set of payments, typically they're going to use an amortization schedule or term. Then there's also most debt is going to be secured by some level of collateral, especially as developers purchasing big ticket items, investing in big ticket items. 9 times out of 10, you're going to be required to collateralize it in some way, shape, or form. Typically with these investments, they're going to be looking at the building or the asset that you're purchasing as the collateral. And finally, as far as debt is concerned, it's going to definitely be backed by some type of legal document, typically a real estate contract called a mortgage. Again, we're familiar with these concepts in the residential personal aspect. It's kind of the same thing when it comes to developing and real estate development as well. Next slide. So let's go a little bit deeper into what debt is. Again, debt is an instrument that is borrowed. Borrower is obligated to pay back with a predetermined set of payments. Again, a debt is going to usually consist of a loan amount. Again, the amount that you're going to look to borrow. Again, you're going to have to factor in as the developer the interest rate or the amount a lender charges. Basically, you're buying money in essence. Then there's a term that you also want to take a look at. We'll talk about the terms and how they're different from like a residential loan. And then lastly, you want to always, as a developer or an investor, you want to make sure that you're looking at that payment as well too. All these factors go into the type of debt and how it's going to be structured as related to your project. Next slide. These are some typical terms. This is a typical term sheet that you'll receive from a bank. Maybe not just look exactly like this, but again, it's going to highlight various things. We got the interest rate is going to take, you're going to have to evaluate. Depending on your credit worthiness, you may be able to adjust or negotiate better interest rate terms. Loan amounts, again, you want to take a look at that as well too. Many programs within the city of Cleveland can go up as far as $5 million. Again, repayment terms is very critical. You want to make sure you're keeping an eye on that. The longer the term, typically the lower the monthly payment will be. We want to look at the requirements. Again, when you're going into a debt situation, many banks or lenders are going to look at your credit score. They're also going to look at how much you're able to put down. Something that I tell developers and business owners all the time is a lot of times the amount of money that you're able to get on a loan is dictated by how much you can put down. So if you're not able to put a lot of money down on a project, that typically is going to mean that you're not going to be able to get a large dollar amount loan. And as mentioned before, you're definitely going to have to make sure you're considering any kind of collateral requirements, as well as making sure you understand clearly what the uses of the loan debt will be. Next slide. And just lastly here, let's just take a look at some differences between a residential, which we're pretty much all familiar with, as well as commercial real estate. So commercial real estate typically goes to an individual, residential typically goes to an individual. But later on within this session, we're going to talk about how commercial real estate usually goes into a business entity name for reasons we'll talk about later. Within the residential side, a lot of individuals want to stretch out that payment as long as they possibly can. Typically, a 30-year fixed rate mortgage is pretty popular. Within the commercial industry, you typically see ranges between 5 years or up to 20 years. And what's different a little bit is they typically like to stretch out the amortization schedule so that the payment is lower, understanding that possibly they're going to have to make a balloon payment at the end. And lastly, the loan value ratios, or LTVs, are typically also a factor when it comes to debt. For residential, high loan value rates are common just so that folks can afford to get into a home. While when it comes to commercial spaces, you might see loan value somewhere between the range of 65% to 80%. Again, this is the amount that that the bank is willing to loan against the value of the property that you're looking to purchase. Next slide.
And so all of these functions are the elements of debt, and there are many different types of lenders, different types of loans. They come with all different shapes and sizes, whether you are getting a loan for $1,000 or $100 million. They may all have different types of loans. You can have auto loans, you can have personal loans, you can have home mortgages. All of these, there are different types of loans that are issued by banks or different types of credit facilities. So the big question that you want to ask is, what is the right type of loan for me? And typically you'll be able to walk into any type of bank and ask that question and be directed to different types of programs and different types of loans where bankers have different options for you, or could direct you to the right type of loan. So let's do an example. This is sort of an interesting, we wanted to break it down pretty simple, because it's all the same concept, right? You're borrowing money and paying it back is all the same type of concept. When kids want to start a lemonade stand, they know that they need to borrow $10 from their parents for lemons and cups. The parents want to teach them about borrowing money, so they say they're going to charge 2.5% interest on their payment, and they want it paid back over the next 4 years. So what do the kids have to do? The kids have to create a schedule. They have to figure out how much money that they need to pay plus interest to make sure that they can pay off this debt to their parents for their lemonade stand. Now, I would tell you that Microsoft Excel is an extremely powerful program and can do all these calculations for you. But what I've done here is I've laid out the basic elements of what we already talked about a few slides ago. The total amount that's being borrowed here is $10. The rate that is being charged by the parents is 2.5%. They want it paid back in 4 years. And so Excel will do a nice little calculation called a payment calculation, or you could use a financial calculator to calculate how much payment you'll need to make for each period, starting it in the first year and working your way down year by year to make your interest payment and the principal payment, so that you can get down to zero by the end of 4 years. And so you can see there, this is called an amortization table. This is what Michael was referring to earlier. And so on the left, going from left to right, you have the period, the number of periods, the starting balance of the loan, the amount of payment that is needed to be made, which is made up of the next two columns, interest and principal. Then you subtract the total payment from the starting payment and you get the ending payment. And that, done 4 different times, because there are 4 periods, will get you down to 0. This is the same type of calculation that someone would make for a 30-year mortgage. You would just have many more columns. You would have, you could have up to, if it was a monthly payment, you would have 360 payments over time. Certain types of loans have what's called adjustable rate mortgages. And so the interest rate changes throughout time. So you need to know the difference whether your loan is what we call fixed rate or floating rate. And so these little concepts are all factored in the same way, in the same columns, to make a predictable schedule. You're going to hear me say that a few times tonight, is a predictable schedule for how you're going to pay your debt back. All right.
All right.
Next slide.
Just sticking to the same analogy. So the parents who provided the funding for the lemonade stand not only want to be paid back, but in the event that they are not paid back, they're going to definitely take some collateral. Now, and for a lemonade stand, it's probably going to be something simple as the lemonade stand itself, or maybe it could be a child's favorite toy. But nonetheless, the parents want to make sure that they get paid back. Same line of thinking, a bank want to make sure that they get paid back as well too. So be prepared to have discussions with your lender regarding collateral. Again, collateral is basically what is required when a lender wants some assurance that they won't lose all of their money. If you pledge an asset for collateral, the lender has the right to take action in the event that you do not pay it back. Now, as far as when it comes to development, typically the asset is going to be the building or the real estate that you're looking to purchase. But again, depending on the type of real estate lender that you decide to contract with, they can go into looking at automobiles, real estate, as already mentioned, valuables, machinery and equipment that's found within the building as well too. They may even take a look at some type of insurance policies or cash accounts, depending on how big of a project that you're looking to do. But again, be prepared to have those conversations about what are you going to use for collateral and to give the lender some type of assurance that you're going to pay them back. Next slide.
And then really we just, I think what this brings everything back to those legal documents that we talked about in the last session. So the mortgage that you are going to, that a bank is going to hold on your property is going to document all of these things: the rate, the term, the amount, and what is being held as collateral. All of these documents are going to be entombed in this mortgage and a note and other legal documents that we've covered. All right, great. So a little pop quiz. Just wanted to take a poll in the audience here. Anybody have any idea what percentage of homes in the United States use debt to finance their purchase? I was pretty shocked. So feel free to pop it in the chat if you've got any ideas. Percentage of homes. When we bought our home, we had to use, we got a loan from, 99%. That's a bit high. 50%. All right, we're getting closer. 75. Okay, Terry, very close, Terry. The answer is actually 72%. 72% of all homes in the United States use debt to finance the purchase. So great guesses. You guys got really narrowed in on it there. I guess that just and just so, I mean, that just shows it's such a powerful tool, and how many homes, how many people in this country have taken out loans from banks. Sorry, go ahead.
Oh no, you're good. You're good. I mean, that's a very very powerful tool when it comes to leveraging and getting the ability to get people in their homes. So another important question that has always been brought up to me, and like Michael or Varga, Should I put the property personally in my name or create a separate entity? Typically, people use LLCs or limited liability corporations. Again, you definitely want to make sure you're checking with an attorney and making sure that you are putting yourself and your and the business in the best entity possible. But here are some definite benefits if you do decide to put it within a separate entity like an LLC. First of all, you can protect yourself from personal liability. Again, you're doing this development as an investment. Again, you want to have other people living on the property, going in. You want to make sure that you're protecting yourself and your personal assets against any kind of liabilities that can be held claim to the building or the investment that you are purchasing. There's also tax benefits. You want to definitely make sure you talk to an accountant or a tax professional about the benefits of putting a piece of property in a business name as opposed to personally. When it comes to property transferring, it makes that process a lot easier as well. And then it gives you an appearance, a business-like appearance. When you're doing business out there, you want to make sure that you're positioning yourself in the best light, but putting your property, your business property within a business name, it gives some folks more of a confidence that you're serious about this type of investment. And the last thing, it does allow you to remain anonymous as well too, which is kind of controversial in the CDC world, where a lot of individuals are using LLCs to buy up properties within the various neighborhoods. But that is a benefit for those who want to stay anonymous when it comes to purchasing property as well.
Okay, so let's take a breath for a second and pause and ask for questions. If anybody's got anything so far, feel free to pop it in the chat. It's the building blocks of how we get here.
I think Marga's frozen. If there's no questions, hopefully we'll get Barga back. All right, we'll move on to the next slide. So how do you create income in real estate? Now, typically Barga would have been answering that question, everyone, but in the chat, can anyone, this is kind of referring back to a prior session that we had, can anyone maybe provide in the chat some ways that how you can generate income in real estate? You got rental property. That's a key one. That's a lot of folks. Hold for a financing note, flip. Excellent, excellent. Well, thank you very much for all those responses. All of them are legitimate, and we're going to go to dive a little bit deeper into a couple of those. Next slide. Tax write-off, thank you. So how do you make money in real estate? Well, we already mentioned a couple of those already. As an owner of the property, again, just kind of revisiting what we talked about in a prior session. You can sell your property, that's flipping. Typically, you want to purchase it at a lower rate or a lower cost, upgrades, whether renovations or improvements, and then hopefully sell it for a higher cost. Typically, you're going to probably have to pay some capital gains on that, but again, the increase in value and the increased purchase price will hopefully offset that. And then you can lease out your property as well too. That's what many investors do. They purchase property, whether that could be residential or that could be commercial, and they sublease out, not sublease, but lease out the various units at different price points depending on the square footage. Additionally, real estate investors make money through real estate income. So when they lease out those spaces, the income that comes in, they are able to generate income. Appreciation over time. This is what makes real estate so attractive. Though we did have that major housing crisis a few years ago. Again, real estate is relatively safe when compared to other kind of factors as well too. Nonprofits, profits generated from business activities, as well as another way to make money. The benefits of investing in real estate include passive income, stable cash flow. Again, you will be entering into long-term, if you're doing commercial, long-term release agreements as it relates to that stable cash flow that you can expect. Again, going back to that passive income, again, real estate, when I sometimes use the word passive income, there's definitely some type of work you'll be doing. Again, you got to maintain the property. But I guess what they mean by passive income is not like you're going to a 9-to-5. Tax advantages that you can take advantage of. Again, definitely want to make sure you touch bases with your accounting for that, as well as leverage. Again, what we love about leverage is that you're using other people's money. You use less of your money so that you can take advantage of an asset, get the benefits, and hopefully use any kind of other cash that you might have for another type of project as well. Barney, you're back.
Sorry, I lost my internet connection there for a second.
All good.
So apologies. All right, so let's talk a little bit about pro formas. Thanks, Michael, for keeping the ball rolling here. So that big complicated spreadsheet that you were just looking at is called a pro forma. And a pro forma is a chart that predictably can predict what is going to be the money that you are going to make off of your real estate project monthly, annually, and year after year, so that investors and bankers can feel confident in giving you this money. The pro forma is the basis by which all of the bones of the dollars and cents that go into your real estate project get analyzed. And so every little line item here is designed to give you some type of understanding about what is happening at your real estate project. The pro forma is not actually a complicated spreadsheet. It is not. It doesn't do crazy, wild, fantastical math calculations. But what it does is gives you that predictable schedule of cash flows that we are going to get to in a minute. So let's take the top, and I've circled here at the top. A pro forma follows a general pattern, and the first item that we want to analyze is income, and the cash that is going to come to you or to your real estate project is the first thing that we are going to analyze. So, Michael, how do we calculate income in a real estate project?
We calculate it by actually, when it comes to your rent rolls, typically. So the income that you're getting off the leases or the rents from the tenants that you have.
Exactly. If we go on to the next slide.
All right, so here's a perfect example. Again, this is part of the whole PROFORMA process. And so you want to definitely make sure that as a developer, that you're sitting down with your team and really getting a good understanding that, again, we're kind of thinking with the end in mind here. You want to definitely, we'll talk about this a little bit later, that return on investment that you're making. You want to make sure that you're calculating the right price or right lease rate for the property that you have so that you can cover costs for the expenses that we'll go into a little bit later. At the very bottom of this particular sheet here, again, it gives a couple of different scenarios using different type of information. Again, you want to sit with your team and really kind of sit down and say, hey, what is the ROI that we want to get on this property? Let's put ourselves in different kind of scenarios so that we understand, how far this investment or how much of an investment or return on our investment we can get.
And remember that we covered this in session 2 when we talked about site selection. So the ways that you are evaluating how much income you can generate from your product depends a lot on the market that you are in and understanding the sub-market and the other properties that are renting up around you. And so we showed a number of different tools on the internet, different websites and companies, and even just asking other people around the neighborhood how much do you pay in rent? How much would you pay in rent? How many bedrooms do you have? These type of things help you define what that rent roll is going to look like. So moving on to this slide here and really analyzing the second piece in the pro forma is understanding about the expenses of your building. And so we always put income, which was the previous slide, over expenses. And so when you're thinking about expenses in a property, you can move on to the next slide. We think about a lot of different types of little nitty pitty types of fees, things that come up. Who's paying for that? If you have to pay a property manager and staff to come work at your building, are you making monthly repairs and maintenance to different units in your building? You always have to pay your property taxes, and that goes as an expense that you are paying. All of these little expenses that are listed here are costs that you pay, and they get lumped together in the second part of the pro forma. And so we always say income minus expenses gets us to this idea of a net operating income. And when you're looking at this is the first major thing that you always want to make sure that you are evaluating, because if your income is not greater than your expenses, then guess what? You're losing money. So, so that's the first thing that you always want to make sure of. And so if we go on to the next slide, I think we have a little bit a better example of how this is broken out.
Yeah, so this hopefully is simplifying all the numbers that we had on the prior few slides here. Really, it comes down to gross potential income. How much money can I charge my tenants when it comes to the lease that we're going to have with them? You want to minus any kind of vacancy percentages. So for those property owners who have multiple tenants, you always want to account for the possibility that you're not going to be leased up 100% of the time. So make sure you're checking out any kind of industry standards and factor in what percentage of the units do you anticipate is going to be vacant in any time of the year. Factor that into your price. After you factor that in, it's going to give you effective gross income, kind of what to expect, accounting for the vacancies in the property. Then you want to take your operating expenses, again, that we just talked about. Again, taxes, insurance, maintenance, utilities, reserves. You want to take these things into account and then add back in any kind of reimbursable expenses. For example, this is typical for commercial properties, but again, these things are like property taxes, property insurance, maintenance, repairs, general operating expenses can be found as far as reimbursable expenses. And lastly, that's going to give you your net operating income for your particular property. So again, this is very simplified. Again, you want to definitely work with your team and kind of factoring this all out. But at the bottom line, you definitely want to make sure that you are charging enough to make sure that you're covering all your expenses in order to make sure that you're getting some type of return.
And so here at the bottom, before you go on, I just want to let's just take a look at this little chart. Here we show a 12-month or 12 periods that we are evaluating over time. And so in each month, we have allocated what we think the income is for each different month. Maybe we have tenants moving in, maybe we have tenants moving out. Maybe we know that the building is going to lease better in certain months. Maybe we just have a better sense of when a property is going to be doing better than others. Then again, you've got your expenses. So now in this case, we usually like to think about expenses as flat. We don't like to think about expenses as going wildly out of control throughout the year. So we've generally set the expenses here at $4 or $5. And this again, so income minus expenses gives us this NOI. And so you can see here, if I've done these calculations right, NOI is our should be income expenses columns. All right, so after NOI, there are two other things that we need to think about before we can get to cash in our pocket. One is capital and leasing costs, and the other is debt service. Now, capital and leasing costs are one-time, unexpected sort of expenses that you might have to put into a project. They could be a roof repair, they could be a mechanical system that needs to be replaced. You know, we're not going to get too much into that tonight, but it is something that needs to be accounted for. And then lastly, debt service. And so we've talked about this idea of debt. We've talked about how to calculate how much payment you have of your debt that you've borrowed. And this needs to be paid back before you can put your cash flow into your pocket. So on the next slide, we've gone a step further, and I've tried to allocate a few capital costs. You can see here, I should have numbered these rows, but your capital costs, and then your debt service. Notice that your debt service is flat. This is where we get back to that idea of a predictable schedule of values, and this idea that the bank is loaning you money on terms that are not going to change. So you should know all the time what your debt service is always going to be. And then your cash flow here is subtracting NOI minus these two other columns or two other rows from this. Now, can anybody see anything wrong with anything good or anything bad with the way that this schedule is shaping out? Any hands, any chats, any ideas? What do we think? Do we like this schedule? Yes or no? Looks okay. Well, I would tell you that, let's see, yes, years 6 and 7 are negative, which means that you do not have enough net operating income to cover your other expenses, your capital costs and your debt service. So that is actually very bad. Correct, Teresa. That is absolutely correct. And the bank, if you can't pay off your whole loan, guess what? They're not very happy with you. And you don't ever want to be in that situation where the bank is not happy with you because you can't pay off your loan, because guess what? They will come after your collateral. And the concept that Michael was talking about, if you have pledged your motorcycle, or you have pledged your boat, or you have pledged your diamond ring, the bank can say, you know what? You can't pay me back my cash. I'm taking that, and I have the legal right to do so. So that's why investors want to make sure that they have this predictable schedule of payments and values, so that they can see. All right, we've come to Act 2, at the end of Act 2, and so thoughts on proformas. That was the quickest run through of a proforma I think I've ever done, but I was happy that we were able to get it down to those core concepts. Are people lost? Are we good? Can we move on? Do we want to stop for questions?
I did see a question in the chat, but I thought we could just wait at the end since we'll definitely have some time about nonprofits and LLCs. You can definitely take a look at that.
Okay. Okay, great. Great. All right, let's keep rolling.
All right, so as inspiring developers or real estate investors, you get into this because you ultimately want some type of money back to you. No one gets into these type of situations or deals not wanting to make money at the end, or at least most folks are looking to ultimately make some type of return on their investment. Just think, you have the option of choosing many different type of investment tools, whether that could be stocks and bonds, whether that could be other forms of real estate, whether that could be, collectibles, something where you said, hey, real estate is something that I want to do, but I want to make sure that if I'm going to tie my money up to something, I want to make sure I get a decent return. So in this session, we're going to definitely talk about ROI and why it's important for your investment.
Okay, great. So Michael just covered this. You might remember this slide from if you joined us for our first session, because like Michael said, real estate is an investment vehicle, and you can invest in any of these different types of vehicles here that are shown, and they all have different rates of return. And so what, real estate uses this predictable schedule of cash flows to give you an idea of what return you're going to get. So let's go back to our example we've been using. If we were to jump back to and just look at the cash flows from our previous example, I've added in here a year zero. And year zero is really meant to represent the initial investment that a person makes in a property. If you were to, this is the money that you are going to buy or take out of your pocket and put into a property that is then going to generate, as we know, based on the schedule, the predictable schedule that we were just modeling, years 1 through 5 here, and we'll expand that in a minute. When we think about this in terms of cash outflow versus cash inflow. And so that red -12 represents, say we bought this building for $12 in years 1, 2, 3, 4, and 5. We are going to be making money starting in year 1 through 5, but we don't have that money to spend in year 0. We are using our own money. So we are out, cash out in year 0. Next slide, please. Okay, and so here we put the whole thing together for you to think about. So here's the same schedule. Year 0 shows our cash outflow, and then years 1 through 12 are going to show our cash flows that are coming in based on what we know about our property, our income that is set on our rent roll, our expenses that are set on the building maintenance and other expenses that we incur, our capital costs, our one-time fixes that we need to make to the property, and our debt service that we are collecting or that we are paying back to the bank for the money that we have borrowed. And so this entire stream from year 0 to year 12, we use a calculation called internal rate of return. And going back to this idea of what is our ROI, we can calculate using Excel and other financial calculators the IRR of this stream of payments, the initial out and the annual in that come along with our property, that this comes out to 4% return. And you might say, 4% return, is that good or is that bad? Well, great question. We're not evaluating good and bad at this moment. All we're doing is we're saying that this is what this property is going to produce. If I pay $12 for it in year 0, and I know that all of these years the values are correct and we've looked at everything, analyzed everything, I'm going to make 4% return on my initial investment. And so the total cash out and the total cash in over those periods, while they, for in this case, they actually sort of add up to $4, but that's neither here nor there. It's 4%. So we use this calculation on every real estate deal, on every single analysis that's done based on those cash flows. Next slide, please. Another example here where we've got a little bit rounder numbers or with some zeros added in, shows that in year 0, we have a cash outflow of $100,000. And that is how much we pay for the building. In year 1, 2, 3, 4, and 5, we are making positive money, cash inflow. So that cash inflow is, it looks like $5,000 for each year. And then in year 5, maybe we are selling the building for $105,000. And the analysis on that net cash flow across the bottom line is your IRR at 5%. So why is this important? Going all the way back to the very beginning of this series, we talked about the difference between a market-based approach to real estate development and a place-based approach. When real estate developers are analyzing projects, they're looking at the cash flows of projects all over, ambivalent to where they are developing. From the community development perspective, we are looking at a place-based model. We are trying to do real estate development in the inner city in Cleveland here in Midtown. And we are thinking about, we don't have the luxury of looking at different cash flows from places in New York City or San Francisco or Houston. Our focus is solely on our neighborhood. And so there are certain constraints that we are faced with. And the market-based approach really allows the giant, what we call the capital markets, or the giant pool of money that is out there investing in different projects to chase the project that is going to create the greatest return, as opposed to the place-based model, which is trying to do development for all of the social benefits and everything that you see on the right-hand side of the screen there. Next slide.
All right. So we're coming down close to the end here. So as potential future developers, you want to really think of everything that you do in real estate from a developer's perspective. And as you calculate the IRR, you want to look at, hey, 12% versus 7%. I mean, that sounds great, but you want to definitely make sure you're looking at the overall big picture. That 12% is nice, but they also might take some additional energy to do that. 7% might be right up your alley. You may want to consider all the things and factors that go into getting that 7%. But you definitely want to make sure that as you evaluate various deals, you want to make sure that you always have that end in mind. What is it that I want to get out of this? Sometimes, and I had one developer I worked with, they did it for very altruistic motives, which is perfectly fine. They were willing to give up that high rate of return in exchange of hitting on the various community benefits that Barbara talked about in the previous slide. So again, going into this as a developer mindset, again, the goal is to make money. The question is, how much money do you want to make? And is it worth the time, energy, the cash that you'll have to put into the project to make that happen?
So the questions that you have to start to ask yourself is, what is your return threshold? Is it 7%? Is it 12%? What are your investors' return thresholds? Where can you put your money, and what return are you looking to make? You could take your money and put it in a savings account, and you can make, I think it's 0.01%, which is, that's what the savings accounts are worth right now. That's nothing, right? It may be less risky to do that, but if you are looking to get different rate of return, you may look at multifamily housing differently than you look at single family housing. You'll have to understand what is your threshold for what you want and we are not investment advisors, by the way. We're not lawyers, we're not investment advisors. I feel like every session we have to make some type of declarative statement that says, because really, I put up that poster of the Wild Wild West. When you get into real estate, there are a lot of things that are up to you. And what is your comfort level? So, these are the questions that Michael was just saying. If you have an altruistic developer who is willing to take 7% to do a deal as opposed to 12%, that may be 1 in a million, and that's really up to him to make that decision. So let's just talk about a few other quick little concepts about how to, while we're talking about return on investment. And this is a term that you may hear, a little slang term, or how do you juice an ROI? How do you get an ROI to creep up north, right? We had 4% on our model. And what can we do to get that ROI to go up to 5%, to 6%, right? And so if we were to pay less money up front and still maintain the same cash flows, then you get a better rate of return for your money. Maybe you're able to get a better loan with better payment terms, or a better interest rate, or a longer term. Different types of loans can generate different type of payments. Then you can obviously look at minimizing expenses. You can look at your property, and you can try to, maybe you don't want to hire a property manager. Maybe you don't want to make those capital improvements. Those are costs that you can determine whether or not you want to pay them. The other, and by minimizing costs, you get a higher NOI, and a higher NOI gives you a higher cash flow. And so, and then you can increase your income. You can increase your rent. You can add more units. You can charge additional fees. All of that is possible, but you still need to make sure that people want to live in your building. And so if you are looking to rent an apartment for $2,000 for a 1-bedroom, maybe that is out of line with the market. Maybe you're taking a risk. But that's definitely a way that you could try to increase your income. And then lastly, you can look for some public subsidy. And so there are a number of government programs that are designed to help with community development. And so we're going to go over a few of those now.
One last point about that slide, as you think about your rate of return, just know that everything that Barga mentioned are trade-offs. So for example, if you do not want to have a management team managing your property management team, because you want to get a little bit more rate of return, just keep in mind that you will have to probably take in your own time and energy to actually do that as well too. So again, a lot of things as you factor in the rate, and that's what's great about the various tools out there that can help you calculate and tweak. You want to just figure out, where am I comfortable at, knowing that any decision that I make to get more money typically comes with some sort of a trade-off that you have to consider. With that being said, we definitely don't want to leave without an opportunity to maybe talk about some ways that you can leverage other people's money. And so what I'm finding is a lot of folks do not know that many of the municipalities, particularly the larger ones, have programs designed to incentivize investment within their particular neighborhoods. So the City of Cleveland Department of Economic Development and the Department of Community Development has various programs for you to consider. Here's a list of some of the programs that are currently available. There's also probably many others that you may want to take a look at as well. So for example, the Vacant Property Initiative was a very popular program within the City of Cleveland. Basically, unfortunately, that the City of Cleveland had a lot of vacant property over the years as people kind of moved out to the suburbs. So one of the ways to incentivize development within the City of Cleveland was the Vacant Property Initiative, which basically was a forgivable loan, provided that you were able to come up with a project. And something we didn't talk about that much, Richard, that I think maybe for another future session, is talking about site control and the importance of you got to make sure that you have ownership of the actual site as well too. So this list can actually be found, or something similar to it can be found on the makeincleveland, I think, .org website. I think they've updated the website name. We'll put it in the chat for you. But this list that talks about all the different programs that the City of Cleveland has can be found on their website if you go check that out. Again, what's great about these programs is it kind of provides that gap financing that many investors need or developers need. They're able to bring in some equity. They're able to bring in some financing, but again, if the sources do not meet the actual project needs, you won't be able to get the project done. So the City of Cleveland found a way to actually provide some gap financing to help you make it to the finish line for your project. Next slide. All right, lastly, Cleveland Neighborhood Progress has a subsidiary called Village Capital. Village Capital's objective is to provide financing for catalytic real estate projects that strengthen and revitalize communities. I did provide a link. If you want to learn more about what VCC does, please feel free to check out that website or give me a call and I'll make sure I direct you to the right person. Next slide.
All right, lastly, I think in terms of ways that real estate developers make money, and we're just talking about like cash flows and everything using debt. The last thing is really when you you can, in certain instances, you can take a development fee off of putting together a real estate deal for somebody else. And so a model that we've seen that's been successful is especially around low-income housing and tax credit programs that are available where developers are able to take a fee off of building low-income housing and other deals as well. But just wanted to make note of that. If you don't have site control, or if you don't have the equity to put into a deal, you can put a deal together. And so that's our last point. All right. Whew. Michael, another huge session where I feel like we've covered more than we should have. Maybe we break this out into multiple sessions, but let's pause for questions here before we wrap up. Would love to see if people have thoughts or other ideas about ROI, proformas, amortization tables. All of these are really complicated, and people definitely spend their lives and careers working on them. So
I'll go back to the question about, can a nonprofit form an LLC by itself and or with other entities, maybe for profit, to own the property? You definitely want to make sure you check out your bylaws as it relates to your or a nonprofit organization. Make sure that it's within the bylaws to do those kind of things. But I've had nonprofits start separate LLCs for the purpose of purchasing real estate. I've seen some churches or heard of churches doing that, for example, whenever they want to buy property. Again, the goal is, again, get the property out from under any kind of personal or protected against any kind of liability. So that is an option. You definitely want to talk to a legal attorney or a tax professional, consult with your board as it relates to forming an LLC for the purpose of buying property. Anything to add on that, Parker?
No, I think you covered it. Just another question in the chat came in. Absolutely, you can get the list, and we'll send out this PowerPoint deck to everyone that showed up or signed up for the session today.
In the chat, I did put the link. It's called makeincleveland.org. And just because the site has a lot of information, within that link, you should go directly to the incentives for the city of Cleveland. Again, hopefully everyone will select the city of Cleveland, but again, no matter what city you reside in, definitely check with your municipality, as they could be a great place to start those discussions about real estate development or real estate investment within those particular neighborhoods.
Okay, and one other thing that has come up, maybe we could go on to the next slide, is if people have specific legal questions, you can go to the Legal Aid Society. We have the Legal Aid Society of Cleveland, which provides free legal services to community groups. As Michael and I have said and have been told by our lawyers, we are not lawyers. Please do not take our word to be the law, but there are lawyers that are out there that can help navigate these type of questions. And then, just so everybody knows, on Midtown's website, we have posted. We have a new link, midtowncleveland.org/RE-literacy. We have posted each one of the videos for the past sessions, which are all up online, and the presentations for each one of the sessions with the links that we've talked about and provided. Wanted to just get a quick plug in for our YouTube channel, Facebook. Follow us on Instagram and LinkedIn. Our marketing people always telling me to plug those things, but a few other programs that are happening here in Midtown. Of course, every Tuesday we have our food trucks called the Chomp. It's back in action, so stop on by Colonel Young Park, 46th and Prospect. We're super excited about our giant mural fest, where we're going to paint 20 murals across Midtown, August 23rd to 28th, called Cleveland Walls. So look for more information on that. Our neighborhood career hotline for folks who are looking for job training has launched with our partners at Towards Employment. And lastly, but not least, we are having our first in-person event scheduled for July 27th with Daniel Gray Contour and our Innovation Intersection series. Please, if you're interested in hearing about his great work that he's been doing with the Huff Youth Council in and around Midtown, we're super excited to have him join us in person. So, Michael, I'll turn it over to you for some final thoughts.
I'm sorry, I'm on here. So just some final thoughts, everyone. We would love to get your feedback. If you were able to join us on each of the sessions, we definitely want to hear from you. So for those who've been participating, we'll be sending out a Survey Monkey that basically would love to get your feedback regarding the presentation, what you liked, what you did not like, so that we can improve next time. Again, upcoming projects we're thinking about and considering is do a podcast. It's really going to take a lot of the concepts that we talked about throughout the 4 sessions and kind of do it in a more of a real world, kind of talking to actual developers and business owners who actually, and community leaders who actually go through this on a day-to-day basis. And look to have our in-person session sometime next year. So again, your feedback will be very much appreciative if you can provide that to us. And that's it.
That's a wrap.
Thank you, everyone.
Just wanted to say thanks, everybody, for joining us. It's definitely been a crazy journey to get here. We've been really excited about all the content, but thank you so much. Thanks to Michael, thanks to Cleveland Neighborhood Progress, thanks to everybody for joining us tonight and in any other sessions. Again, we hope to see you soon.
Thank you.